Today we're going to talk about the most commonly understood yet least specific tool in forecasting recessions and market corrections. So we do almost all of our banking now, both personally and professionally, online. But I had to go to a bank yesterday, and they still have that little window card that says, the CD rate for a 1 year is X interest rate, 2 is a little higher, 3, 4, 5, and so forth. So that would typically be a smooth curve where the longer you give your money up, you should get a slightly higher interest rate. So when those lines flip, that's called a yield curve inversion. A shorter term asset has a higher interest rate than a longer term one. Now, the 2-10 inversion is specifically what we're going to look at today. And the reason why that's important is that it's predicted 11 of the last 10 recessions, meaning that when the 2-year Treasury has had a higher rate than the 10-year, that's happened 11 times over the last 50 years, and 10 of those times we went into a recession and correction. It's by far the most accurate single facet in predicting recession and correction. However, I mentioned that it's also very inaccurate. The reason being, it predicts that in the next 6 to 24 months, we're going to have that happen. And that's not very good to time the stock market, not that we do much of that anyway. But using that as an investment tool is a little bit like timing a 100-yard dash with a sundial. It's just not precise enough for specific action. But let's look at this inversion and see what we can learn from this. So on your chart, you see the 2-year Treasury and the 10-year Treasury. And you'll see that on July 27th of 2022, the 2-year line moved above the 10-year line. That's that indicator that's been right 10 of the last 11 times. And again, the most accurate tool for predicting recession and correction. And you'll see that that gap began to widen and continue to widen. Even when we had the banking crisis in March, you remember Silicon Valley Bank didn't match up their assets and liabilities very well, and that bank is no more. Well, both of those dropped sharply, but the 2-year still remained above the 10-year. Let's look at a second factor that lets us get a little bit closer to when these corrections and recessions typically begin. And that's looking at the 2-year Treasury relative to the Fed funds rate. The second graph allows us to have a little bit more precision relative to the oncoming potential recession or correction. Now we're looking at the 2-year Treasury relative to the federal funds rate. And what we see here is the 2-year Treasury is higher than the Fed funds rate, but as the Federal Open Market Committee and the Federal Reserve react to inflation and begin to raise the federal funds rate, then it moves above. So when you see that 2-year drop below that straight line, that means the 2-year Treasury is selling at a lower interest rate than the Fed funds rate. So this is the second big signal we look for, and again, inching closer to potentially recession and correction. The third big factor that we're looking at, again, as we potentially inch closer to a recession and correction is, at what point does the 2-year Treasury capitulate and begin to drop relative to the 10-year Treasury and go back down below the 10-year Treasury rate? That hasn't happened yet, and so we're looking at that as one last signal. Now, from an investment standpoint, again, these are very imprecise factors. There's a lot of time that transpires between these things happening and the next thing happening. And to be honest with you, we rarely try to time the market. What we might do is we might tweak a little bit one direction or another with what we expect. The last time we did this was during the 2020 COVID correction, where we moved to cash relatively quickly, cashed out some other assets that were up, then decided to allocate that after the market had dropped about 37 points, primarily back into stocks. It was really just a matter of rebalancing and overweighting into areas that we thought were undervalued. This is the first time we've really done this since 2020. And again, we're making really gentle tweaks to the portfolio in expectation that we will be moving into recession in the next 6 to 12 months, and that recession hopefully will be mild. But nonetheless, we want to have some dry powder to take advantage of a potential stock market on sale. That's a look at the 2-10 inversion, and I hope this has been helpful. We hear a lot about it in financial news, but I hope the next time you're at a picnic or a cocktail party, you now feel a little bit better empowered to take that discussion one more level deeper. This is Fred Baerenz, AUG Wealth Management.